Hands up who is a founder, startup mode in the room. Okay. And of you, how many are early stage? And how many are scaling stage? Okay. And for the rest, how many are investors? Excellent. And I'd say the rest would probably fall into professional services and other areas. Yep. Excellent. Okay. So, the way we thought we'd run today's panel session is I'll just give a bit of an overview, introduce the panel, then get them to introduce themselves in terms of their background, and then we'll go through a couple of hot topics, at least as we think they might be for you. So, as I'm sure most of you would have noticed, there's been quite a change in the startup scene in Australia and more specifically in Sydney, I would say over the last 12 to 24 months. Whether that means there's more cash on the table and more funds available is another matter, but there's definitely been a sense of excitement. So the government's National Innovation and Science Agenda, the NISA, that was announced in December last year, had 24 initiatives designed around improving the innovation ecosystem, startups, assistance. So changes around bankruptcy, changes to employee share schemes, the angel investor tax break, which is now in effect, changes to early stage venture capital limited partnerships. All of these have been modelled to some degree on what's being done overseas to see if we can get that sort of success here. So within that context, it's probably a good time to go across and talk to the panel about their experience. So I'll just do a quick introduction and then throw to these guys. So Ian Buddery is the chairman of Maestrano and comes from an investment background and entrepreneur background himself.
Yeah, I'm a software engineer.
By you started out?
I'm an accidental investor.
Okay. Mehul Patel is the chair of Hyde and also comes from an investment background and also from entrepreneur, I think, a little bit. And John Henderson is a partner at Airtree Ventures, which I imagine most of you would know. And Dave is a partner at Carthona Capital, which I would assume most of you would know as well. So we have the VCs as well. If I go to each of our panel members and get them to give you a background about their journey and how they've arrived at where they are, and then let's talk about where that synergy is between investors and startups and how you get that flowing. Ian?
I did my first startup when I was 19, which eventually failed. Many years later, I started another company. Am I holding that close enough? The light's off. Okay, that one's working. Sorry. I did my, I founded a company in 1991, which I eventually ended up taking venture capital investment and eventually listed that company on the Australian and the London stock exchanges and sold out to Oracle in 2010. Since then, I've invested in and helped raise money for a number of startups, and Maestrano is the latest and the best known of those.
Yep. And so that's started in Australia, but I think has got some application offshore already.
Yeah, we're in 6 countries now, and we've raised $7.5 million up to from at the beginning of 2014.
Uh-huh.
Hi, so Mehul Patel, CEO of Hyde. We're a recruiting marketplace for hiring high-impact knowledge workers. We started with engineers. Thrilled to be here. We're actually announcing our launch in Australia, in Sydney and Melbourne this week. The team is over there. Go over and say hi. My background, first half of my background is as a lawyer and then as a business general manager in public companies. Ranging from software all the way through to media. The second half of my career has really been focused on smaller companies, particularly focused on marketplaces, particularly focused on services marketplaces. I'm sort of very taken by the idea of the future of work and how career decisions are so fundamental to people, and there's not a good way to find a new career. Have been hired for the last 3.5 years. We've raised over $70 million. We're now in 17 markets globally, and have a team of 250.
John?
Hi, John Henderson. So I'm with Airtree, and we've just announced a new $250 million fund, which is, I think, good news for Australia. I'm fresh off the boat, so I'm the new guy. I think that'll make sense if I explain my background. So I started out co-founding a company called Bush Campus, which we ran for a couple of years and then drove into bankruptcy for a whole bunch of different reasons. And then I got scared of entrepreneurship and startups and had what I call my dark period, where I was a sort of lawyer and management consultant for a little while. And I got over that and joined Facebook, which got me back into the exciting stuff, from which I joined a machine learning company as the COO called Sunly, and we were acquired by Yahoo in 2013, and then I've been in venture ever since then. So for the last 3.5 years with a firm called Carthona Capital in New York and London, and then for the last 3 months with Airtree.
Thanks. John? Oh, sorry, Tony.
I don't mind what people call me, so it's fine. Yeah, I actually got into entrepreneurship quite late in life after a career in corporate, and I've been on both sides of the fence. I started a business here in Australia about 14 years ago that Leo actually works for. I know Leo from, I guess we hired him into that business using some of the techniques that we just heard about, I think. And I sold that business in 2014 to Infosys, the big Indian services company, an IT company. And then I went into another startup, which was starting up a VC company, Carthona Capital, with some partners. And over the last 3 years, we've made about 25 investments across a very wide variation of types of companies. We've got a few that are doing really well and a few that are really struggling, and that's probably the usual mix with startups. So I've seen both sides of the fence, good and bad, and hopefully shed some light on that today.
Okay, so given the wealth of experience these guys have between them, I'm thinking one of the questions I would have is, if you were to put yourself in the shoes of particularly an early stage startup, what would you be looking at in terms of, and particularly in light of the environment as it is now, with some of the changes and around tax breaks, around funding sources, around crowdsourced funding, peer-to-peer lending, all those sort of things, what would be your tactics and strategy now if you were looking at, you're in a startup, early stage?
Oh, you're damn. I picked the wrong chair. Look, I think rule number one, it's really hard to raise money. It's never simple, it's never easy, and you can't prescribe a one-size-fits-all model. There are multiple paths, multiple approaches to raising money. I think the most useful thing you can do is get yourself in front of as many people as possible, network through organisations, entrepreneur organisations, and build a network amongst people who either are investors or who know people who are investors, and wait for something to click.
I'm going to jump around a little bit. So over to you, John.
I think these things are more interesting when panelists disagree with each other, so I'm going to slightly disagree with that. And one of the rants that I go on regularly, which I'll repeat here, is my best advice. The first advice I would give you is work out what type of funding is appropriate for your business, because venture, which is the type of funding that Dave and I do, isn't appropriate for many, many business models. That's point one. And then point two, which is my rant, is I think you can waste a colossal amount of time fundraising by talking to the wrong people. And so what I advise founders to do very early on is to do reverse due diligence on the people you're speaking to. So for example, ask questions like, when did you raise your fund? And if it was more than 4 years ago, the chances are they're not actively investing. Look through their portfolio, look at, have they invested in kind of companies that are similar to you guys or at a similar stage or kind of where there's some comparable somewhat recently? If no, then they're probably not likely to invest. And you know, you can run through a whole bunch of questions like this, talk to some of the founders that they've spoken to if you're getting more serious, but do your reverse due diligence early to figure out whether this group or this individual has a realistic chance of investing in a business like yours and has done that in the past. And if not, don't waste your time, because the one thing about fundraising is you can have a gazillion meetings, but if you're having them with the wrong people, then you know it's even worse than not doing it at all.
100% agree. We're not arguing at all.
So, I mean, they say that debt is cheaper than equity, so at what point does that equation change? Maybe over the board.
Well, I mean, echoing I think John's point. Yeah, I mean, I think there's this sort of fascination in startups with raising venture money, and I just don't think it makes sense in a lot of scenarios. I think that as the cost of sort of starting a company and getting into traction has come down over the last couple of decades, I think that there's an opportunity for startups to actually get to a position where they don't need venture money. So I think that's a whole slew of startups, and I think that lens around getting venture, because that proves your company is off. But if you're in a group that actually needs a significant amount of capital, equity obviously makes better sense than debt if you're not in a position to service the debt. So the question then on equity is sort of how much of the company do you give up? And I think where people get stuck is one, how much they raise, and that should be coming from the investor and the check that they write. That should be coming from the issuer and how much they need for the next 12 to 18 months. Two is how they talk about what they need to raise. I think a lot of investors just come in saying you need $10 million, but they don't say that $10 million will last me for 18 months and move this metric from here to here and let me do these things that will let me raise again. That's what these guys care about. And then I think the third is just understanding kind of dilution, and I think there's sort of a focus on the valuation of the company and not just the terms, but also kind of the dilution you're taking to raise money.
Dave?
I sort of put things into an Australian context. As you mentioned, Georgia, there are quite a few ways in which the government are trying to help, both the New South Wales government and the federal government are trying to help startups on their journey, and I'd recommend that you really avail yourself of what those things are, and whether it's the R&D tax offset, or whether it's some of the commercialisation grants, or some of the tax benefits now they're offering to investors. I think when you're armed with that kind of information, you can get your business quite a long way and reduce your capital requirement by taking advantage of some of those, some of the things that are out there. Because really, when you're starting a business, the worst thing you can do is have to raise a lot of equity, right? Because you give away so much of the business in order to do that at an early stage. So the more you can make yourself last until you've reached that sort of inflection point with your business, the minimum amount of capital you need to raise during that process, and the more you can get the government or whoever else is offering grants or relief on tax at least to you, it's going to really help on the journey. I think that's our advice to a lot of the startups we see that really probably don't need our support.
I always tell people that you've got to think about where you're going to be 4 or 5 years down the track, and how much money you're going to need to raise, and where that is going to leave your voting control of the company after you've gone through 2 or 3 rounds. Because one thing is for certain, if you are not in control and something goes wrong, you will get fired from your own company. And that happened to me. It happens all the time. And so the golden rule for any founder is to stay in control for as long as possible. And that generally means raising as little money when your valuation is low, so that you don't lose great chunks of equity early in the piece.
So let's talk about the early stage for a second, the angel investor tax break. So that's been modelled on the UK one, which is actually a 50% tax rebate. So those of the UK might be aware of that one. In Australia, it's a 20% rebate, and then the shares are capital gains tax free for the first 10 years that you hold them, as long as you hold them for 12 months. Has that changed the early stage? The policy intention behind this by government was to make capital cheaper, if you like, at the seed Series A stage. Is that something that you're seeing in the market? Who would like to answer that?
I don't think we're seeing the flow through yet. I think it's still early, but maybe what I can comment on is the UK situation, because I was there for the 6 years when the SEAS and EIS schemes happened over there. Broadly speaking, tax breaks for angels are a good thing. Like, the more capital that flows into the system, the more ideas that get funded. We'll have the same failure rates. Like, this doesn't make companies better, but it means that there's more ideas around there, and therefore there'll be more successes applying the same failure rates. In the UK, we saw, I think the numbers were something like sort of 2,500 additional businesses being funded year on year as a result of these schemes. People argued that this sort of pushed the problem upstream, and you had a Series A crunch, and there's always a complaint about these things, but I think broadly speaking, if the government can get out of the way in terms of regulations and on sort of workplace issues, and can provide incentives for angels to contribute more to the ecosystem, I think that's a good thing.
So maybe picking up on your DD comment before, what are the things that the startup should be looking for in potential investors?
Apart from money. That's the last thing actually you should be looking for from an investor. I mean, our experience is very much it's about the people, and you want your investors to be adding as much value as possible to the business that you've got. So I think somebody said earlier that you've really got to pick the people you go to speak to first, and you should identify the investors who have got a track record in the kind of business that you're hoping to build, because they're going to be the people that are really going to add value to you in those first few years of building that business. And if you get the sense they're not going to do that, or that's not their business model to help you on that journey, then I think that can be quite an issue. And certainly, our model is invest in fewer but spend more time with those that we have, so that we can actually help them on the journey in a big way, hopefully along the way.
Yeah, I think it's about the individual partner and not the firm. So, I think people often pick the firm based on its cachet, reputation, but you care about the partner. And then, to pick up on Dave's point, it's a marriage you're getting into, a decade, maybe a longer, not a first date. So you better find someone who's shares some of the value, some of your outlook on the industry, someone who can give you the right amount of kind of kick in the backside, but then also support at the right times. That's very much a people thing. I'm always struck by how little diligence companies do on the partner, and how they're all expected the other way. It should be flipped.
Yeah, I've certainly been aware of what their market knowledge is, industry specialisation, even looking across the different funds have got different areas of expertise, but aligning that in from an angel investor point of view, I would say it's equally important. If they're coming on board and they're effectively being part of the team, you want to leverage that as much as possible.
But I actually think it's more than expertise, right? Like, if you're taking capital from an investor, whether it's an angel or a fund, it's usually on the promise from them that they'll help you in some way beyond money. Test that promise first. A good investor will add value before they give you a term sheet. And if they don't, then what does that say about the ongoing relationship over the next 10 years? So, like Mehul says, do your reverse diligence, but also, see if they actually add value during the process.
Yeah, actually, that's a great point. So our fundraising strategy, having done this for a long time, done all the things wrong, this time around with Hyatt has been to everyone saying, let's form a relationship, and the best way for you to show value is to make introductions, help us into the space, give us some of your resources, and then those that have actually helped us have been the ones that have actually got the next round. So yeah, absolutely.
Goes around, comes around, right? I think the other thing that to think about is, where do you see your business going in that 4 to 5 year horizon? If you're going to go international, if you need to go international because of the model of your business, then you need to pick an investor who's got contacts and knowledge about doing things in other markets, which isn't always the case. So it really does, you really got to think about this before, I think is the point, before you get into bed with someone on that front.
So what are the key strategies there? I mean, if you're looking at, and part of this topic was around, exit strategy, IPO, going global. And let's talk about, at what point do you start looking at, offshore, and in what sense do you look at that? And when would you consider an IPO, and when would you not? I mean, they probably don't quite have the same valuation that they did a while ago in the market. So
I think there's two questions there. One is when you go offshore, and the other is when you start thinking about an exit. I think again, it's a function of what your company is, what your what your product is, whether you're just a derivative of some international company that you've launched in Australia, or whether you've actually got a unique idea which is going to get traction in offshore markets. If you're in that latter situation, my view is that as soon as you've found a go-to-market model that works, then go hard and go international. You spread your risk across more countries and more economies, and you're less likely to suffer from short-term down cycles. Home in Australia, we have a tiny economy and it goes up and down faster. If you get into the UK or the US or Asia, you're going to be more resilient, and your revenue is going to be more scalable in the long term. In terms of exit or IPO strategy, IPOs are not an exit. IPOs is just a different way of raising money. It's certainly no exit for the founder. You do an IPO if you want to tap into public capital markets, and if you want to get the added stature and credibility of being a publicly listed company, which does help you in a lot of markets when you're talking to certain customers. And you do that, you launch an IPO when, if you're going to do that, when you've got to the point where you have predictable growth, predictable revenue, because the worst thing that happens is missing a target as a public company, and then your share price gets slammed, and most of the time won't recover.
Would like to add to that?
I think on the going global point, Ian's right. It totally depends on your model. I like to think about it like a broad framework. I like is one that I've shamelessly plagiarized from my friend Christoph Jans at Point 9. He talks about, in the B2B context specifically, he talks about, I think it's rabbits, deers, and elephants. And so there's this theory that to build a really big B2B company, you either need to sell to hundreds of thousands of rabbits, and by rabbits he means sort of, annual contract values of less than $1,000. And if that's the case, then the chances are you're just throwing up a website, people are coming to you, so you should go global from day one. And so examples within our portfolio of that type of business are things like Canva, which is reasonably well known in Australia, Alivio, and a whole bunch of others. Then you've got Deer, which is sort of $10,000 and average annual contract values. Then you probably can't just throw up a website. In order to sell a $10,000 deal, you probably need some kind of inside sales org, some people on the phone, that kind of thing. In that situation, you want product market fit in your local market to a certain extent before you start selling internationally. And then there's the elephants, which is the sort of hundreds of thousands of dollars contract values that you're selling. And then you need a full sales org, like boots on the ground, long sales cycles. And so Paxata in our portfolio just raised a sort of $40 million round, which we're part of. And a big part of that is to roll out into enterprise in Australia. When you're at that stage and you need people on the ground and expert sales forces and developer evangelists and everything that comes along with it, then I think you really wait. I think you prove your unit economics, you prove you have product market fit, and then you launch with a serious capital base. So it really depends on the model, but I kind of break it down into those three categories.
I think that's a good way to look at it, actually, and makes a lot of sense. In terms of IPO, as Ian said, I think that it's just, you should look at it, it's just another way to fund your business. And depending on the markets, on the segment you're in, on the venture capital firms, other sources of equity, you're just going to line them up and decide which is going to give you the best outcome you want at that point in time and what you need. And it's not a magic cure, right? It's not a magic cure to become an IPO. We've seen a lot of, I think particularly the last year, there's been quite a few that have gone to IPO way too early.
It's outrageous, the garbage that gets listed in Australia.
And we're seeing that, and that's coming back to bite, because there are even some good businesses now are hurting having IPO'd because of all these sort of, as you say, the garbage that's been put on the ASX in the last couple of years, because it's been attractive and the people have thrown money at these businesses. So I think it's all about the cycle and the timing as to whether you choose to do that, and also about how stable and confident you are of your business and where it's going.
IPO is a means, not an end. I mean, where we sort of motivate the team is less around having an IPO and more about being IPO ready. And there's a distinction. So certain companies shouldn't go public. Certain companies go public only because the window is open. Certain great companies can't because the window is closed, i.e. you don't control when you go out. But I think that the discipline to reach, whatever the metrics are here, in the US it tends to be 100 million revenue, 40% year-over-year growth, a path to profitability. Those are important things for any business. So we sort of focus around that versus the goal of an IPO, because it is just a fundraising mechanism.
I tend to think that having built a business and then sold it, that we never ever thought of an exit. We just decided, let's build a great business, and then the rest will happen, right? I think that's the way to. The first and foremost is get your business right, minimise the amount of equity you actually need to build it, and then if you have a successful business, then exits will appear in front of you. People will chase you to do the IPO or the trade sale, whatever it happens to be.
Yeah, I think that's right. I think if you focus a team around an exit, all the incentives change, and you probably decrease the chance of good exit. You don't hire expensive people to move the company. You don't invest in sales teams and technology. Try and boost revenue short term.
Absolutely. Yeah. Focus on the business, and fundraising takes a lot of the focus away. You get what it can do. So again, it's something you only enter into really when you've thought it through.
Yeah. I think that as well from what we see. I think you're opening this up to questions in terms of, do we have some questions from the audience? Oh, okay, we've got a few. Start here.
My question's to John. Thank you for the panel. It's been quite diverse. My question relates to the rabbits, deer and elephants. A number of us, I guess, starting software service as a service companies have an expectation or have existing revenue models that are monthly service fees, which equate to retention, especially in the B2B space, of customers year on year in. So you're not looking for new customers necessarily, you're maintaining them. So my question is, are you a deer or are you an elephant if you say do a $20,000 to $30,000 annual contract with somebody with the experience that they will stay with you for 5+ years, maybe 10, because the history of changing, as it was mentioned one of the previous speakers, changing systems is not an inexpensive exercise. You just don't change these sorts of things. I'm talking about a true B2B system, yeah? It has a revenue model, software as a service. So my question is, are you approaching it for capital, seeing yourself as a deer or an elephant in that case?
Well, just to be clear, so the analogy is you're hunting these animals, so your customers are the deer or the elephant, rather than the business itself, if that makes sense.
Well, the business is each customer is worth $30,000, say, a year to the business. And so I want to understand whether the business is seen, because you were talking about revenue models.
So I think the analogy is how do you get to $100 million in revenue in any of these businesses? And the idea is that if you're hunting rabbits, you need hundreds of thousands of them, therefore you need a very scalable, low-cost way of acquiring them. Whereas if you're hunting elephants, you probably need 1,000 of them.
So I guess my question is, are you hunting an elephant or are you hunting a deer if you know that you're going to have an annual revenue that's not just one sale, but will be annualized over, on average, 5 years, and it's a $30,000 sale? Is that $150,000 sales to a venture capital? That's my question.
So that would be a deer.
That's a deer. Okay, so annual. Thank you.
Next question.
And so just to expand a bit more, the assumption is that for any good SaaS business, you'll retain them over many years.
Okay.
I was about to say, I'll just repeat the question. So essentially, there's been some interest by superannuation funds over the last 12 months in terms of entering the startup market, I suppose, in terms of funding. And how does that sit? There's always been a bit of an issue around prudential obligations. So, and that landscape is changing. Would that be it? Okay. Over to you, Dave.
Yeah, no, it's a very topical conversation, and we have been approached, just in the last 12 months, we've been approached by a number of super funds and other funds who traditionally haven't been in this space, looking for partners to provide the expertise to basically invest their money for them on their behalf in this area. So, you know, we're in those discussions, working out whether it fits with our model, whether it fits with their model, because obviously it's very different for them. The risk profile and the way in which you manage the investments is totally different to their traditional, you know, invest on the ASX or big business. And we are talking with a number of those funds currently about how that could work. But I think the good thing is it's just showing there's more interest, there's more capital coming into this space. And that can only be, as we said earlier, can only be a good thing ultimately for the startup community here in Australia. Exactly what the model is and how that's going to work with all the other, you know, the requirements these big businesses have, I'm not sure. I'm not sure how that model's going to work its way out. But I think in the next 6 months we're going to see more and more of the Carthona-like VCs in the startup space actually accessing some of that capital in one form or another and bringing it into the startup area.
John, did you want to add anything from your perspective?
Exactly the same. So in our last fundraise, we have some super funds involved, but they're just investors in our fund, like all the other rich people who invested in our fund.
I think about a year or two ago, I heard a comment from, I think it was First State, talking around the prudential obligations and saying if they take 100 mil that they're investing and they put it, you know, a certain percentage of that into startups and it goes down, well, it doesn't actually affect them that much over the longer term. But the state of the economy does in the longer term, and that's why they see it as consistent with their obligations to actually have a spread portfolio into startups. Now, whether or not that carries through the industry is another matter, but that was the way it was put in the public forum anyway.
Well, this is the case in the US, right? So pension funds and endowment funds are some of the biggest limited partners, so investors in the US venture scene. And for them, that's, you know, it's simply a portfolio allocation decision. Most of their money will go into, say, things like bonds and gold and whatnot. And then they'll have an allocation to PE and a smaller allocation to VC. And, you know, these are big multi-billion-dollar organisations that invest in a lot of different things. And I think what we're starting to see in Australia is an appetite for some of their portfolio to be allocated into venture funds like Carthona.
We had another question over there just before we...
Yeah, so I had heard that raising money in Australia is, I guess, it's split at the lower end of the angles that provide up to $250 million or thereabouts, and then the VCs do you want multi-million-dollar deals, but there's a gap in the middle. Is that still the case, or it sounds like things are changing?
Yeah.
It's definitely still the case. You know, Australia is one of the hardest places to raise that mid-range money, and you're at the mercy of your network and the angel investors you bring in your seed round. You'd like to hope that you're bringing in angel investors who can network you into people who will help you cross the chasm when you need to raise 4, 5, $10 million. But it's very difficult, and in my candid opinion, nothing that any politician has done or can do will solve that problem here.
I think that's exactly the reason why we started Carthona, was because we saw that gap. And we're just one of many that would be required to fully meet that need that's in the market. So the good thing is there seems to be more money and there seems to be more interest in that sort of space. But I'd agree it's still a gap, and we see way more businesses than we can ever support. And I know that a lot of them never end up finding that support they're looking for, and they have to find other ways to either bootstrap their business or give up and try something else. That's the reality of it. Or go to the US and look for money there.
We have another question there, and then I'll probably only take one other if there is, before we should have time.
Adding on to the question of John about my experience as an investor and an angel investor is that we'll often do second and third round funds, funding Series A, etc., for companies that
So to repeat that, essentially, is as an investor, once you've come in for the successful ones, then you're in for later rounds.
Can I disagree again? I'm not entirely convinced about this. I think all the reputable venture funds in Australia will write smaller checks now. I think everybody is going downstream to plug this gap, and I think what Dave's doing at Carthona is a great example. We wrote a $250,000 check last week. We wrote a $200,000 check 3 weeks ago. We wrote a $750,000 check last month. I think there are people filling this gap. There's always going to be companies that struggle to raise, and there's always going to be a complaint that that there aren't funders in certain parts of the market. But I think in this specific gap between sort of, I think it was 250 and millions that you referred to, there are venture funds playing in that space, and there are people who can write checks. There might not be enough of them, but it's not like they don't exist.
I suppose one final question from myself, and that is one of the things that, again, we see as well as investment coming in from overseas, particularly from China. And I suppose, is that something that you as a panel are seeing as well? Or is it, we're just sort of starting to see the start of this particularly interesting funds coming into the country, partnering to get an AFSL, and then start seriously investing?
Yeah, so we're seeing lots of this. We invested in Accel with Accel last week. We've co-invested with Union Square a few weeks ago. Safety Culture just raised a round from Index. Atlassian is famous for raising for Accel. So I think historically we've seen some interest from big US firms, and we at least are seeing much more of it right now.
Yeah, we're seeing the Chinese money coming in, and even Moelis and Company have got a fund that is actually just about to invest in one of our businesses. So it's definitely happening.
Yeah, I think Australia is perceived as an undervalued market, and so for offshore investors, we are an attractive bang for the buck because for a very, very long time, Australian companies have generally had much lower valuations than US or UK companies, which is in itself a problem because there is a massive cultural cringe in Australia, and the whole system here is geared to talking down valuations, and it's very much focused when you're at the capital raising stage on discounting your valuation extremely aggressively, and in my opinion it's not focused on where the end value potential of the company is. So why is an Australian company worth half of the equivalent US company? And the only difference is that typically if you're an Australian founder with an Australian company, you automatically get hit with a big discount. And I don't know how that's ever going to get fixed, apart from, in my personal opinion, I try and invest in companies that have got global potential so that you can get out of Australia relatively quickly and take on investment from markets where you don't have that discount issue.
Unfortunately, I think we're out of time. Otherwise, I was going to jump in with, okay, if you're going offshore, what jurisdiction and for what market segment, but I think they'll have to wait till another day. Can I ask you all to thank the panel for their time?